Welcome to Frazier and Deeter's webcast, Interpreting the New Tax Law. Today we're talking to two tax experts. Bryce Nations is a Frazier and Deeter tax partner who works with high net worth individuals, flow-through entities, foreign institutional investors, and closely held businesses regarding their tax planning. Lucia Sneal is an attorney and tax professor in the School of Accountancy at Georgia State University's J. Mac Robinson School of Business. She is the former editor of Tax Notes Today, a publication of tax analysts, and a former legislative analyst for the Congressional Research Service. Lucia, could you give us some background regarding the new tax law?
So the passage of this tax bill is just the beginning. From here on out, for the next year and 18 months in particular, there's going to be guidance coming out of Treasury and the IRS that really helps explain and flesh out some of these issues. And so we expect that there'll be very significant guidance coming out with more detail on exactly how these provisions are going to work. And taxpayers and tax professionals are going to have to keep their eyes on this very closely so we really understand how to implement this law and certainly how to plan around it for the most favorable outcome.
One of the more popular tax provisions that was passed in this recent act is the Passthrough Entity Tax Deduction. And this is the 20% deduction that you've probably heard about already. And you're probably curious how it works. But I think before we talk about how it works, I think it's really important to think about why this is even in place. The corporate tax rate has been reduced all the way down to 21%. Congress knew that if they pushed through that legislation, that they were going to have some issues with the remaining businesses across the U.S. because most of them are actually small business. These pass-through entities, they want to get some type of tax benefit as well out of this act. What Congress came up with is they came up with sort of a 20% haircut off the top off of this pass-through income. And so broadly speaking, this covers a lot of taxpayers. It covers not only sole proprietorships, which if you think of it, that's actually single member LLCs primarily. It also covers partnerships, both limited partnerships and general partnerships, limited liability companies or LLCs, and S corporations. Given this maximum individual rate of 37%, the effective maximum tax rate on this pass-through income is now 29.6%. That's a fairly significant reduction in the tax rate. So to give you sort of a basic example here, a taxpayer owns a small business that generates $100,000 in pass-through income. The taxpayer would get a $20,000 tax deduction against this income, which leaves $80,000 of income taxed at individual tax rates. So before you can take this deduction, it's important to understand what you're taking it from. And one of the key definitions that we need to talk about is what is qualified business income. Obviously, qualified business income includes ordinary income from operations, but it also includes a couple other things. Income from rental property, rents, that's included. REIT dividends, dividends from any type of cooperative are also included, and also publicly traded partnership income. Now, what does it not include? It doesn't include compensation paid to owners, which includes reasonable compensation, and that's a reference to S corporations and the shareholder owners of those. It also does not include a partner's guaranteed payment for services, nor does it include any amount paid to a partner for services outside their role of a partner. Also, any type of investment income. Think of capital gains, dividend income, interest income, any type of portfolio investment type income does not count for this. Now, it's worth mentioning that there's other types of capital gains that will qualify. For all my friends in the real estate industry, 1231 gains would qualify. That was not the intent of this bill to do away with any type of business gain or loss. And last, foreign earnings will not count. So here's another simple example to kind of talk about the interplay of the compensation limitation and the guaranteed payment limitation. So a partner who has partnership profits of $150,000 plus receives a guaranteed payment of $50,000. If you think of this, the easiest way is to kind of visualize what a Schedule K-1 looks like. And so that $150,000, that's going to show up in our example here in box 1. So the very top of your K-1. The guaranteed payment amount, that also shows up on your K-1, a couple boxes below the $150,000. So based upon those facts, you can only take the deduction on the $150,000 amount. So that's just the amount in box 1, not the full $200,000 in income that you've actually received as a partner in that business. It's also important to understand that not all services or industries will qualify for this tax deduction. I think the easiest way to kind of break down this new tax provision into sort of bite-sized chunks is to think of it in three different buckets. You're pretty much going to fall in one of those three buckets. If your taxable income is below $315,000, that's married filing jointly, and the phase-out limit is exactly half if you're single, approximately $157,000. If you're below that amount, it really doesn't matter what industry you're in. So you can be a CPA, you could be an attorney, doctor, any other type of consultant or sell professional services, and you should generally be able to basically take the 20% deduction off your qualified business income. However, if your taxable income increases above that $350,000 amount, that's the floor of the threshold calculation. And that threshold runs for $100,000 for married filing jointly. And again, it's exactly half if you're single, all the way up to $415,000. If your taxable income is in that range, $315,000 to $415,000, you are limited. So there's basically a phase out, and it's a pro rata phase out. So if you're $50,000 above $315,000, then there's a 50% reduction in the amount that you would otherwise be able to take. And so that calculation also has to be done if you're in that range. Once you reach the ceiling of the phase out, so that's $415,000 for married filing jointly, or exactly half, $207,000 for our single filers, you've got several other limitations that kind of kick in. The first one is that once you reach that, service industries no longer qualify for this pass-through deduction. And so that includes CPAs, law firms, doctors, any type of consultant, financial planners. But an odd thing here is that at the very last minute, Congress decided to make a special carve-out for engineers and architects. They are still able to take the 20% pass-through deduction above the $415,000 threshold. I'm sorry to all my friends out there that are in service industries or consultants, but that's just how the law was written. What then happens, once you weed out all the service industries, those that are left still qualify. They have two hurdles that they have to meet in order to still take this tax deduction. So the first test they kind of have to run through is the wages paid test. And so what happens is the amount of the 20% deduction that you can take is limited to 50% of the W-2 wages paid by the business that you're trying to take the deduction on. The amount of wages paid to you is basically a calculation of your allocable share of how that tax deduction would have flowed to you. So if you are entitled, in your partnership to get 50% of the profit or loss, then you would get 50% of the total wages that are inside that partnership allocated to you for purposes of this calculation. So a lot of my clients that are in the real estate industry, they comment, well, that's not fair because we hold real property, and we hold this real property in special purpose entities. And inside those special purpose entities, we don't have employees. So we use a management company, either a related party that acts as a management company or an unrelated third party that manages our properties for us. And they provide the employees and they pay the W-2 wages. So what are we going to do then? Well, they came back and they said, okay, and at the final hour before they passed this thing, we'll add in an alternative calculation once you're above $415,000 of taxable income. And that alternative calculation will be 25% of wages paid plus 2.5% of the cost of the tangible depreciable property held by the business. And when they say tangible depreciable property, they actually mean the original, cost basis of the property. So this is not the adjusted, tax basis. This is the original tangible property value when you purchased it. Since it has to be depreciable property, that obviously excludes land. So keep that in mind when you're doing this calculation. And then also keep in mind that these limitations for wages and property are computed on a business by business basis. So you can't aggregate a bunch of your pass-through investments to try to reach some of these hurdles with the W-2. A few more key things to keep in mind as we wrap up discussing this pass-through deduction. The pass-through deduction is actually not treated as an itemized deduction. If you visualize your tax return, where we think it's probably going to show up is on the second page of your 1040, probably just above your taxable income calculation. It's not going to be lumped in on Schedule A. This is going to allow taxpayers to take this deduction even if they don't itemize. So I think that'll probably be a positive for small business and is a win for most taxpayers. Also keep in mind that the deduction will not lower your AGI, which at first glance you might not think is a big deal, but your AGI is actually used in the tax code to calculate a lot of other limitations, such as retirement plans, charitable contributions, things like that. So that is sort of an unfavorable result, but really just something to keep in mind. And then finally, 3.8% net investment income tax. So that's that section 1411 tax is still going to apply to any type of pass-through income that is passive. Now, an interesting fact is that for the 20% tax deduction, both passive and non-passive partnership interests will qualify for this. So that is a taxpayer favorable provision in this new act.